Hi, hi everyone over there. Today we'll be talking about prior period adjustments, IAS 8, prior period adjustments, changes in accounting policy, and changes in estimates, and segmental reporting. But we shall keep segmental reporting on hold for a minute. But let's talk about prior period adjustments. Which are the issues that can bring about prior period adjustments? One, we can talk about errors, yeah. I can talk about changes in accounting policy. Say last year there was an error in the accounts, and it has just been discovered this year in 2019. What do? We go back and and make changes in the financial statements last year. And if there is any resultant change, let's say in retained earnings, it has to be reported in the statement of changes in equity, showing a change in the retained earnings. Let's talk about changes in accounting principle. How does a change in accounting principle happen? Say last year we were valuing an item or stock at, let's say, weighted average, yeah, and this year we're applying FIFO. This is a change in accounting policy, yeah, this is a change in accounting policy. So what we do, we go back and apply FIFO on the closing inventory value for last year, and definitely there will be a change in retained earnings, because if there is any change in closing stock, the cost of sales will change, and definitely there will be a change in the profits for last year, and consequently the opening reserves will change, because if there is any change in cost of sales, there will be a change in retained earnings or profits. So if we apply FIFO to last year's inventory, where we've been using weighted average, there will be an effect. And remember, if we are to present financial statements in a faithful manner, we have to apply consistency when we are applying principles, or when we are doing some treatment on items in financial statements. So this year we're trying to adopt FIFO for our inventory. What can we do? We have to apply the same to last year's in order to make comparison, or to make the items or the financial statements to be comparable. We should be able to compare the invest last year and invest this year. Yeah. So yeah, that is a change in accounting principles. So how about a change in an estimate? Changes in estimates should be applied going forward. Say last year we were applying, let's say on fixed assets, we were using reducing balance kind of method when we are depreciating items, and this year we've seen it fit and reasonable to apply straight line method. We've been using reducing balance, and this year we want to apply straight line method. So what do? We have to apply the same principle this year going forward, but we don't have to go back. Unlike changes in accounting policy, where we apply the principle retrospectively going backwards, for a change in an estimate, for example, depreciation, a change in provision, we apply the change going forward this year and next year. Yeah. So thank you so much, guys. Yeah. Let's see